Okay, pay attention now. Hello, guys, pay attention now. Suresh, this flap up. Which section you can see now? Which section you can see now? And what is written besides this? Discussion to be done under section 112A. So in the last part of the chapter, tax rates, we are going to discuss about the tax rates on long-term capital gain under section 112 and 112A. That time, when I will be discussing the long-term capital gain under section 112A, that time 55 to AC, the cost of acquisition. I will discuss this thing in the end. This is very important section. So I want all of you to, remember this section, because this is tested in the exams also. So I will be taking up this part in the end. Okay. Now let's move on to the next discussion. Okay. See, read this part and tell me what is the meaning of this. Did I explain something like this? If you can see in my notes, okay, which I am writing in front of you, okay? Cost of acquisition can be, it can be 55 to A, double A or AC, yes or no? AC I am going to discuss end. Or sometimes the notional amounts can also be taken as cost, that we are going to see later on. The moment you have determined the cost. Now, cost of acquisition needs to be indexed. How to do the indexation? I have also discussed this part. Okay, how to do the indexation? Cost of acquisition multiplied by CII of transfer year divided by CII of acquisition year. And if the asset was acquired prior to 1st April 2001, take the CII of which year? 2001 to divide by 100. Okay. Now, indexation to be done only if capital asset is, and transfer of the capital asset is made prior to. But if the transfer is made on or after, then the benefit of indexation will not be available. Yes or no? Now this is a small discussion which I would like to do about shares. See, sometimes the shares of same company are acquired in different lots on different dates at different cost. So each lot will be treated as, and for each lot the capital gain has to be calculated separately. Hello? Because it is not necessary that the shares bought in one lot and the shares bought in the second lot, the period of holding is same. The period of holding will be different. The period of holding of first lot, based on that, the shares are long term. Period of holding of the second lot, based on that period of holding, the shares will be short term. For example, the shares of XYZ Limited, same company. Okay, I am buying 100 shares, 200 shares, 300 shares, 400 shares. How many lots? 4 lots. All the shares are of same company. Same company. Can you see? I am buying those shares at different dates. First lot I have bought on 1st August 2016. At what price? Second lot I am buying on 9th September 2018 for third lot of 300 shares. I am buying on at what rate? And fourth lot buying on at what price? Now pay attention. How many shares I am having? 1000 shares. Yes or no? What if I sell all these 1000 shares on 20th of, can I say 100 shares bought on 1st August 16 or bought on, sold on? In these 1000 shares, 100 shares will also be sold, no? So tell me, what is the period of holding of 100 shares? 1st August to 20th July. Period of holding is more than 24 months. Short term or long term? Long term. So long term gain will be calculated for those 100 shares. Okay. At what price I have sold? At what price I have sold? 115 will be the full value of consideration multiplied by 100 shares. Yes or no? Minus transfer expense. I will get net consideration. I will get net consideration. Out of that, I will have to reduce the cost. Cost of these 100 shares was 50. Will I index or I will not have to index? Index. Why? Because see, the period of holding is more than 24 months and the transfer is taking place prior to. So the cost of acquisition will be 50. I will have to index it. Index cost of acquisition I will reduce. Yes or no? Then this second lot also I am selling. When did I buy? When did I buy? And when I am selling, can I say the period of holding is more than 24 months? For how much I am selling? 115 multiplied by how many shares? Will be my full value of consideration minus transfer expense. Net consideration. What cost of acquisition I will reduce? 80. But will I index? The answer is yes. Because the period of holding is more than 24 months. Yes or no? And the transfer is taking place prior to 23rd July. So indexation will happen. 80 into will be my cost of acquisition multiplied by CII of year of transfer divided by CII of year of acquisition. Getting my point? Now tell me, these 300 shares, these I bought on 15th December, selling on period of holding more than or less than 24 months. Short term or long term? Full value of consideration 115 multiplied by will be my full value of consideration minus transfer expense. I will get net consideration. Out of that I will reduce cost or index cost. Sir, I have transferred prior to 23rd July. Transfer is taking place prior to 23rd July. So indexation has to happen. Only if the asset is, but the asset is. So I will just reduce 105 multiplied by, this is the cost of acquisition. I will reduce it without taking any indexation money. Now tell me, these 400 shares are acquired on, sold on, period of holding less than 24 months, 13 days period of holding, bloody. Less than 24 months. 115 multiplied by will be the full value of minus transfer expense, net consideration minus cost of acquisition, 120 multiplied by 400, and no indexation benefit even if the asset is transferred prior to 23rd. Why? Because the period of holding is less than 24 months. It is a short term. For every lot, the calculation will happen separately. Understanding or not? Now see, how many shares you are having? 1000 shares. And what I have written? Meaning all the 1000 shares are transferred? Is it necessary that I will always transfer all the 1000 shares? What if I am transferring only 750 shares? Can I transfer 750? With 750. Always follow FIFO. First in, first out. So in 750, which shares are sold? 100 shares are sold. 200 also sold. Now wait, 300 also. Now 150 shares from 400 will be shares. 400 will be sold. Yes or no? So for those last 150 shares, the period of holding will start from, cost of acquisition will be, yes or no? Now how many shares are remaining? How many shares are still remaining? 250. They are remaining from 400 shares. Whenever those 250 shares will be sold, the date of acquisition will be, cost of acquisition will be, will you be able to do it? These type of questions they will ask in the exam. And if you are not able to solve, congratulations. You are eligible for May 26. Hello? Will you be able to solve? No, congratulations. You will pass in Jan 26. Hello. See, the entire thing, no, I have solved here. Okay. So when you will find these notes, you will get the solution also. Okay. Everything which I have spoken will be there. Okay. So now let's get, if the above example, instead of all the shares, only, I've already discussed, which shares are sold? 100, 200, 300, but these 400 are not sold out of that. So for these 150 shares, period of holding will start from this and day. Cost will be taken as 120. The cost for these 400 shares was there, 150 per share. So for these 150 shares also, the cost will be 120. Getting my point? This is exactly what I have discussed. Okay. Next one. Now see, ignore this question 11. Okay. Now the first part of the chapter is over. Now one small example I am telling you. Small example I am telling you. Okay. You're supposed to open your notebooks. I'm dictating one question. Okay. And you are supposed to solve that question right now. It will cover each and every concept which I have taught you. Done, sir? Sure? So basic question, how to solve a basic question, we'll do that. Okay? Write down. Mr. Gopal. Mr. Gopal, whatever name you like, you can write. Okay. Mr. Gopal acquired a building in 93-94. Mr. Gopal acquired a building in 93-94 at a cost of rupees 5 lakhs. At a cost of rupees, he paid brokerage at the rate of 1%. He paid brokerage at the rate of 1% at the time of acquisition. At the time of acquisition, full stop. He incurred rupees 50,000 on extension of this building in when did Mr. Gopal acquired? 1993-94. And what you wrote? Incurred 50,000 on extension of the building in 97-98 and rupees 1 lakh in 2005-06. 2005-06. So 2 times he has done extension. Once in 97-98 amounting to 50,000 and second time 5-6 amounting to rupees 1 lakh. Full stop. The fair market value FMV, the FMV of this building as on 1st April 2001 was 12 lakhs. 12 lakhs. Make it 10 lakhs. Make it 10 lakhs. Only 10 lakhs. Was 10 lakhs. Okay. And stamp duty value, SDV, stamp duty value, as on 1st April 2001, as on 1st April 2001 was 8 lakhs. Okay, full stop. He sold this building. He sold this building to Mr. Ram on 20th June 2024 for rupees 35 lakhs. Full stop. However, wait. Don't write however. After incurring, write down, after incurring 2% as brokerage. After incurring 2% as brokerage, full stop. Now write down, however, the stamp duty value of this building, as on the date of transfer was 42 lakhs. 42 lakhs. Compute the amount of capital gains. Taxable in the hands of Mr. Gopal. I am giving you 5 minutes to solve this question. Start. You want me to solve this question or you are trying first? You will try, no? Okay. If you read the information in the question again and again, it is not going to help you out. I told you while solving the PGBP question also, no need to read the question again and again. You should be knowing what you want. Look out for those details in the question. By now you should get your answer also. How much? Write down your answer somewhere. Those students who got their answers, please write down your answer somewhere, so that when we'll be solving the answer, you get the idea that whether your answer is correct or not. 2 minutes remaining. Do it fast. Done. Should I start? Pay attention. See. What is the name of the assessee? Name of the assessee? See. Mr. Gopal. He is an individual. If nothing is mentioned in the question, he is ROR. What is his permanent account number? We don't know. Dash. Just for the sake of presentation, we write it. Okay. Which previous year? Previous year 24-25. Assessment year 25-26. So in this assessment year for previous year 24-25, what are we going to do? In this assessment year for previous year 24-25, we are going to compute the taxable capital gain. So we are going to computation of what? Dash term capital gains. Dash term means it can be long term also. It can be which capital gain you are calculating? Short term you are calculating or long term? How did you know? How the examiner will know? Working note 1. Working note. Type of asset and period of holding and nature of capital gain. What? Type of asset, period of holding and nature of capital gain will determine in working note 1. And then here we are writing what? Short term or long term. Then only this fill in the blanks will be filled. Okay. But we know that whatever type of capital gain is there, we will require only 6 lines. We will require only, first we will write particulars. First we will write particulars and then amount. So in this particulars, what are we going to write down first? Full value of consideration. Okay. Now for this full value of consideration, no, I have 2 amounts. One is the selling price and another one is stamp duty value. So we are going to take any one amount. But which amount we are going to take as full value of? For that working note 2. From working note 2, we are going to derive this full value of consideration. So in my bracket, I'll write working note 2 less full value of consideration less transfer expense. You have read the question, no? Yes or no? Is there any transfer expense given in the question? Not given. Not given. 2% brokerage. So transfer expense is 2% brokerage. Now tell me, brokerage you pay to the broker on what? Full value of consideration or selling price? Your full value of consideration can be stamp duty value or it can be selling price. Any one amount will be your full value of consideration. Yes or no? But the brokerage will always be paid on selling price. Yes or no? What was your selling price? So can I say 30 lakhs? 30 or 35? 35. 35 lakhs into calculate. So this 70,000 is my brokerage. After reducing this, I will get net consideration. Net. From this, I will reduce cost of acquisition or index cost of acquisition. Why? See the date of transfer of the building. 20th June 2000. The date of transfer of the building is prior to. So, if the building is long term, which is there in my case, yes or no, we'll index the cost of acquisition as well as cost of improvement. So, less indexed cost of acquisition. For that, I will be doing working note 3 and less what? Indexed cost of improvement. For that, I'll be doing working note 4. Now these two amounts and my long-term capital gain or long-term capital loss. See, this is the only answer which I will have. Correct amount you are supposed to calculate and you are supposed to fill those figures. But wait, if you will solve only this and not provide the notes, you will get half marks. Each and every note is important. So the first note, come on. First note, working note 1 talks about type of asset, comma, period of holding and nature of capital gain. Every question, first note should be this only. Yes or no? Now pay attention. What is the type of asset? Building. Yes or no? What was the date of acquisition of the building? 93. So exact date is not given. Yes or no? But it is 93, 94. What is the date of transfer? What is the date of transfer? 20th June 2024. Can I say from the date of acquisition till the date of transfer? And now see, the transfer is taking place prior to 23rd July 2000. Will you check the old period of holdings or you are going to check new period of holding? Old period of holding for building was, immobile property was, and new is also no change in that. But we are going to check old. Old is 24 months. So can I say this period of holding is greater than, therefore building which is getting transferred is a long-term capital asset. Hence long-term capital gain to be computed. Done, sir? Now in your format, computation of Computation of, only then I will fill this long term. Okay. Now long term capital gain we are calculating. Hence we are doing the indexation. Why we are doing the indexation? Because the transfer is taking place. Transfer is taking place. And we are checking the old period of holding. And hence there is indexation also. Getting my point? So besides this, I will now what I'll do? I'll do working note 2. Now from working note 2, I will get what? Full value of consideration. Now tell me, building is equal to immobile property. Okay. Now if this building is immobile property, what was the sale consideration? What is the stamp duty value? 40. Is this 42 lakh stamp duty value more than sale consideration? What is the sale consideration? 35 lakhs. Now, since the stamp duty value is more than sale consideration and the difference is how much? 7 lakhs. Difference is, and this difference is more than 10% of. Difference is more than 10% of what? Sale consideration, which was 35 lakhs. So take 10% of 35 lakhs. 3 lakh. 3 lakh. So is this difference more than 3,50,000? Yes. Therefore, a section will be applicable. Section 50C. Which section will be applicable? In the case of immobile property which is being transferred, okay, if the sale consideration is less than stamp duty value, meaning the stamp duty value is more, and the difference between the stamp duty value and the sale consideration is more than 10% of, then a section gets applied. Which section? And as per 50C, the full value of consideration which you wanted to take, what? Amount of sale consideration. You wanted to take 35 lakhs. Will be ignored. Will be ignored. And the amount of stamp duty value which was 42 lakhs will now be taken as your full value of consideration. So this way you have given them that how did you arrive at the figure of full value of consideration. This is not going to take more than 30 seconds in the exams. Trust me on this. If you will solve multiple questions in this way, no, in this method, first question will take more time. If you will solve the second question, it will take comparatively less time. If you will solve third question, again some less time. Fourth question, fifth question, now you will not have to, do all these things. On the calculators you are getting your answers like this. But the flow should be understood properly. And in the examination, if you are not going to write all these things, no, trust me, you are not going to get marks. So working note 2, amount of full value of, what is full value of consideration for me? Now I will take 42 lakhs. Out of this, reduce 70,000. So it will be 41 lakh. Tell me how many of you got full value of consideration correctly? Everyone got full value of consideration correctly? And how many of you committed mistakes? Now you understood what full value of consideration is there? Sometimes the actual amount of consideration, but sometimes a notional amount can be taken as full value of consideration. This is the question in which your actual sale consideration was ignored. As per 50C, a notional amount, stamp duty value is taken as your full value of consideration. Got it? Now pay attention. Now Net consideration is there. Now will you calculate cost of acquisition and index cost of acquisition? So working note 3. Working note 3. This note 3. COA and ICOA. And in the bracket you will write, since building is transferred prior to 23rd July 2024. Yes or no? This same question I am going to give you as a homework, but with a small twist. The same question I am going to give you, but with a small twist. And I would like to see that how much you have understood, how much you are attentive in my lectures. Okay. So first, let's solve this, and what change I am telling you, I'll dictate that change and you'll solve the same question at home today. Okay. Now, cost of acquisition and index cost of. Now tell me, cost of acquisition for the building which was acquired in 93, previous year, in previous year 93, 94. Can I say prior to 1st April 2001? So the building which capital asset, immobile property is acquired prior to 1st April 2001. What should be the cost of acquisition? A. Actual cost. A. What is the actual cost? 5 lakhs. But at the time of buying, you paid 1% brokerage plus 1% brokerage, 5,000. Yes or no? That will be 5 lakh. That is your actual cost. Or B. Will you get the option to take fair market value as on 1st April 2001? Is it given in the question? How much? 10 lakhs. But remember, this fair market value cannot be more than stamp duty value as on 1st April 2001 if available. Available or not? How much? 8 lakh. 10 lakh or 8 lakh? Whichever is higher, no? Whichever is higher, no? Or lower? Lower. Sure. So this or this, whichever is lower. So what is the lower amount? So I will put the 8 lakh in circle. So now I will put 8 lakhs over here. Now tell me, 5 lakh 5,000 or 8 lakhs, whichever is higher. Tell me what is higher. Therefore, cost of acquisition is equal to how many of you did it correctly? Excellent. So the only place where you got the problem was FVC, and few of the students can commit mistake in brokerage also. What is the full value of consideration? Many of the students, while writing the exam, they will take 2% of 42 lakhs. Brokerage is never on full value of consideration. Brokerage is always on. See how many places you would go wrong. Number 1, full value of consideration. Number 2, brokerage, you can go wrong. Yes or no? So please avoid these mistakes. Okay. Number 3, cost of acquisition, you can go wrong. Now your cost of acquisition correct amount is this. Yes or no? Will it be indexed or it will not be indexed? Sure. Why? Because the capital asset is transferred prior to. So now what are you going to do? You will have to index the cost. Done, sir? Therefore, index cost of acquisition. First of all, we'll take 8 lakhs. Cost of acquisition. No need to write down the formula also. Okay. Avoid, writing those things. If you are writing this, the examiner is smart enough to understand. So 8 lakh will be your cost of acquisition multiplied by CII of which year? When did you transfer your building? 24-25. So CII of 24-25 was divided by CII of acquisition year. Now the building was acquired. See. If you say that building was acquired in this year and transferred in this year, this is transfer year. CII is 363. Everyone remembers this. And what was the acquisition year? It was prior to 1st April 2001. Yes or no? And for that, you will take the CII of which year? 2001-2, which is 100. Okay, no? So that is the reason why I did not give CII. Otherwise, I would have given. Okay? If I would have said that the building is purchased in 2007-8, 100% I would have given the CII of 7-8. And I would have also given the CII of 24-25. Don't worry. In the examination, they are going to give CII of every year. But index cost of improvement is done in different years. And for that, you will have to take the help of CII table. Okay? So wait. 93-94. Meaning prior to 1st April 2001. So CII of 2001-2. So what is the index cost of acquisition? How much? 29 lakh 4,000. Everyone getting this? Did you all get it correctly? Now this is index cost of acquisition and I will go and put this amount in my table. 29 lakh 4,000. Done, sir? Now index cost of improvement. Working note number 4. I will take cost of improvement and index cost of improvement. Why? Since the building is transferred prior to 23rd July. So I will do the indexation for cost of improvement also. Done, sir? So first of all, cost of improvement incurred in which years? Previous year 97, 98, amounting to rupees 50,000. Will you consider or will you ignore? Why will you ignore? Since I will write down ignored. Since it is incurred prior to 1st April 2001. Okay, now cost of improvement incurred in previous year 2005-6 amounting to rupees. You will ignore this also, no? Or you will consider? Considered. Since it is incurred on or after 1st April 2001. So how many cost of improvements are considered? Both or only one? So therefore, index cost of improvement will be 1 lakh. Will be which have incurred in which year? 5-6. Yes or no? Multiplied by 363 divided by CII of year of improvement. Now see this CII table I just copied paste. Yes or no? So what is the CII of 5-6? 117. So I will divide by 117. Everyone getting it? What is happening? Easy or difficult? Easy? No. Made easy. Say thank you. Calculate. 3 lakh 10,000 250. Everyone getting this amount? This is your index cost of improvement. See, if the first index cost of improvement was also considered, no, we would have indexed that also. Then both the index cost we would have added, and that aggregate amount we have written, we would have to write in the main answer. Yes or no? But since we are not considering the first one, we are considering only the second one we will index that only, and that amount will be the total index cost of improvement. Yes or no? So how much I'm going to write here? 3,10,256. Now please do the needful. 9,15,000. 744. 44 or 34? 740. Positive or negative? This is known as taxable long-term capital gain. And under which section it is taxable? It is taxable under section 112. Now pay attention. Pay attention. In that question, write down one more information. You have some one or two line space, no? Write down. In that same question you are going to write other incomes of the assessee. Other incomes of the assessee. Taxable at normal rates. Taxable at normal rates. Rupees 2 lakhs. Rupees 2 lakhs. And also compute the income tax liability. Assume 115 BSc cross mark. Assume 115 BSc cross mark. I will tell you each and every possibility. Don't worry about it. Now in that same question, see, if I would have given you that information, no, you would have got confused that time. Your focus would not have been on this. I wanted you all to focus on this. Now, some new concepts I will introduce. Okay. Now tell me, did you calculate your capital gains? And in the question they are saying that what is other incomes? 2 lakhs. On that you are supposed to pay tax at normal rates. For example, that other income would have been your salary income. It would have been your house property income, IFOS income, PGBP. It would have been any normal income. Taxable at normal rates. Yes or no? Hello? And the assessee is not following 115 BSc. Assume that also. So he is having other incomes of 2 lakhs and he is not following 115 BSc. Compute his tax liability. Now on other incomes he is supposed to pay normal rates. On this he is supposed to pay? He is supposed to pay special rate. What rate of tax? The long-term capital gain under section 112. If the capital asset is transferred prior to 23rd July, the rate was 20%. So in my case, this long-term capital gain is from a building which was transferred prior to 23rd July. Yes or no? So this long-term gain will be taxable at what rate? So now first thing what I will have to do, see. Now I will write here computation of total income, and first of all I will compute total income. Okay, pay attention. In the computation of my total income, what is the capital gains? What is the capital gains? LT CG under section 112. What was the amount? 9,15,744. So 9,15,744. This will come in my total income. And other incomes. In the bracket I'll write down normal incomes. Yes or no? What was the amount? 2 lakhs. Add both of them. 11 lakh, 15,744. What will be this amount? This will be gross total income. Yes or no? Less deductions under chapter. Was there any deductions? No. So what will be my total income? What will be my total income? 11 lakh, 15,700 and on this total income, now I will have to apply the tax rates. Okay, on the entire amount, I will apply normal rates. So I will apply 20%. Some income is a special income, on that I will apply special rates. Some income is normal income, I will apply normal rates. Yes or no? Now pay attention, very important thing. Out of your total income, do you have LTCG under section 112? This is taxable at the rate of 20%. Yes or no? How much is that LTCG? 9 lakh 15,744. On that I have to pay 20%. Can I say my balance total income is 2 lakhs. Taxable at what rates? Normal rates. Now see, normal rates of 115 BSc or normal rates of optional regime? Because the assessee is not following 115 BSc. I have given you in the question only. Yes or no? So if the assessee is not following 115 BSc, what is the basic exemption limit? Up to 2,50,000, is he liable to pay any tax? So his basic exemption limit is not crossed. He is not liable to pay any tax on this 2 lakh, because that 2 lakh is within the basic exemption limit. Yes or no? Still 50,000 basic exemption limit remains. Still 50,000 basic exemption limit remains. He would not have paid any tax if he would not have earned LTCG, because his total income was within the limit of basic exemption limit. Yes or no? He is liable to pay tax only because of this LTCG which is there in his total income. So first question you are going to ask, is he a resident individual or HUF? If the answer is yes. Is he a resident individual or HUF? If the answer is yes, then that resident individual or HUF will get the benefit of adjusting the unexhausted basic exemption limit from his LTCG. That can be adjusted from LTCG 112 also, LTCG 112A also, and STCG 111A also. From these three capital gains, you have the option to adjust the unexhausted basic exemption limit. So do you have any unexhausted basic exemption limit? How much? So for that, first you will have to write down basic exemption limit, that is 2,50,000. But wait, one question. If you would have followed 115 BSc, then this basic exemption limit you would have written 3 lakhs. Then the unexhausted basic exemption limit would have been 1 lakh. Getting my point? Still the answer would have been same, meaning adjustment would have been done, but the adjustment of only 50? No, adjustment of 1 lakh would have been done. Yes or no? So now tell me, if the basic exemption limit is this much, meaning that unexhausted basic exemption limit is how much? 50,000. And hence he is not liable to pay any tax. Tax here will be nil. Yes or no? So I will say that this is my tax 1. Sorry, this is my tax 2, which will be nil. There will be no tax on this income, and still my basic exemption limit remaining 50,000. Now this basic exemption limit will be adjusted. It will be adjusted. So this adjustment can be done as per section 112. 112 says that your entire long-term gain will be taxable at 20%. Entire long-term gain will be taxable at 20%. Yes or no? But if there is some unexhausted basic exemption limit, after adjusting that unexhausted basic exemption limit, your balance long-term capital gain will be taxable. But this can be done only by resident, individual or HUF. So in the given question, if nothing is mentioned that Gopal is a non-resident, we are assuming that he is a resident and he can very well do this adjustment. So tell me, how much will be reduced from here? 50,000. Got it, sir? Reduce. Now how much will remain? 8,65,744. On that we will apply 20%. Why? Since transfer made prior to 23rd July, at that time any long-term gain on which any long-term gain arising on transfer of asset prior to 23rd July, on that long-term gain the tax rate will be 20%. Okay, so calculate the tax here. So the tax 1 here will be 1,73,149. Yes or no? Therefore tax on total income is nothing but tax 1 plus tax 2. How much? 1,73,149. Yes or no? Now tell me, surcharge will be added or will not be added? Because the total income is not more than, rebate will be available or not available? Because the total income is not up to 5 lakhs. Yes or no? Total income more than 5 lakhs but less than 50 lakhs. So no surcharge, no rebate. But you'll have to give the dowry. And what is that dowry? Health and education cess at the rate of 4%. Calculate 4%. 920, add 1,80,074. Yes or no? This is your gross tax liability. If any TDS, TCS, advanced tax is there, you are going to reduce it from here. And if nothing is there, this is your final tax liability. You'll get full marks. Wait. Wait. You'll get full marks. But she did not allow me to finish. No. Why? Can you see this? What is this? Total income. Can you see this? What is this? Tax liability. Both the amounts are not in the multiple of rupees. Even if the full answer is correct, still you can lose 2 marks. 1 mark for not rounding off tax and 1 mark for not rounding off your total income. So if your answer is perfect, no. So the examiner will now try to find out these silly points. Tell me, total income has to be rounded off to the nearest multiple of rupees 10. So instead of 11,15,744, what you would have written? 740. This should have been your rounded off total income. Yes or no? And here it would have been your 9,15,740. From that 50,000 if you will adjust, so it will be 8,65,740. 40. On that calculate tax. 1,73,000. 148. 148. Now this 173. 173. 148 plus 6926 would have given you how much? Would have given you how much? 1,80,000 0,074. Same amount, no? And this would have been rounded off. 1,80,000 0,70. This would have been your final tax. Got it, sir? So, see, there is not a big deal. Okay, the examiner can skip also. He will give you benefit of doubt. But when your answer is perfect, no, he will try to find these kind of mistakes. That, oh, he has forgotten to round off. Let's deduct 1 mark for that. Okay, so don't give him that chance also. Did I tell you that I have never attempted a single paper in my entire career as a student more than 80 marks? If I am writing my CA exams or my CS exam, any exam I have written, I have never attempted a single paper more than 80 marks. The highest mark which I attempted in CS, in my CS final, in one paper, it was 83 marks. 83 marks I attempted. That is the highest in my entire career. Always I used to attempt 70, 75 and 80 in this range only. I was never a fan of writing full 100 marks. I was a fan of writing full correct marks. Whatever you write, don't give the examiner any opportunity to deduct your marks. And fortunately, so far, if I have attempted 70 marks paper, no, I have definitely got within the range of 64 to 67, 60 to 70. Within that range, there will be no deduction. And if there is deduction, not more than 4 to 5 marks. I always used to attempt my paper like that. I'm not suggesting you to do that. Getting my point? But if you're writing, no, in your exams, write in such a way that don't give him a single opportunity to deduct your marks. Yes or no? Now, did you understand this entire solution? How did you find it? The same question which is there in your notes which I have just dictated, similar type of question can come in the exam for at least 6 to 8 marks. Or a case study can be created on this, and 4, 2, 2, 3, like MCQs will be prepared on this case study. Is it difficult or easy? Provided you remember everything on time and present it in this same manner. Okay. Now, for your homework, do only one thing. Change the date of transfer. So write down in the above question, I'm dictating. In the above question, what will be your answer? What will be your answer if the date of transfer of the building was 31st July 2024 instead of what? 20th June 2024. You want me to give the solution right now only? Or you will try at home? Sure. And please positively try this question. Only then you will get the confidence. I will give you hints also right now only, so that while solving you don't get any problems. Okay. Tell me, Will there be any change in full value of consideration? No change. Will there be any change in transfer expense? Same. Will there be any change in net consideration? Will there be any change here? What change? Now there will be no indexation. So cost you have. Cost of acquisition. How much? 8 lakhs. You will write. Do you have cost of improvement? How much? You will write 1 lakh. Your capital gain is easy. Without taking indexation benefit, you have computed capital gain. So in your working note 1, will there be any change? Yes. On or after 23rd. So you are checking new period of holding, which is 24 months only. Yes or no? Then will there be any change in working note 2? No change. Will there be any change in working note 3? Building is transferred. On or after? So will you calculate? You will calculate only, and you will stop here. You will stop here. Yes or no? Then this will not come. And this cost of acquisition you will write above. Okay? Then working note 4. Building is transferred. On or after? So will you calculate index cost of improvement? This you will write, this you will write, and this you are not going to calculate. Only 1 lakh you are going to write down above. Hello? Now, computation of total income. Will it change? Yes, because the capital gain will change. Capital 41 lakh 30,000 minus 8 lakhs minus 1 lakhs. 32 lakhs 30. Just see how our madam is. She took away your indexation benefit, and now instead of 9 lakh rupees of capital gain, how much capital gain is getting taxed? And now your total income will be 34 lakhs 30,000. Yes or no? Yes or no? And is there any deduction? No. This will be 34 lakh 30,000. Here you will write 34 lakh 30,000. On that, if you will calculate 20%, you are gone. But wait. Unexhausted basic exemption limit will be adjusted. Unexhausted basic exemption limit will be adjusted. Yes or no? So out of 32 lakh, out of 32 lakh 30,000, 50,000 will be adjusted. Okay. So what will be the gain? 31 lakh 80,000. This is the long-term capital gain without taking indexation. On that, how much you will calculate? 12.5%. On that, you are going to calculate 12.5%. Okay. So 12.5% tax you are going to calculate. Wait, that is not the tax which you are supposed to pay. Here you are going to get an option. Since you are a resident individual, acquired the property prior to 23rd July and transferred that property on or after 23rd July. Yes or no? Your capital gain got calculated without indexation. But while calculating the tax, you will get the option to pay tax at 12.5% on this gain, or 20% of the gain calculated by taking indexation benefit, which was same 9,15,744. From that you will take 50,000, because 50,000 if adjusted from here will give you 31 lakh something. On that you are calculating 12.5%. That same 50,000 if you adjust from this long-term gain with indexation, then your gain will be 8,65,740. On that you calculate 20%. Now whichever tax is more beneficial will be your tax 1. Got it? And rest everything remaining same. Where you will get the problem? While calculating the tax. If this type of question is there in the exam note, trust me, it will be for minimum 8 to 10 marks. Calculating the long-term gain without indexation and calculating the tax. With indexation 12.5%, without indexation 20%. Getting my point? Whichever is more beneficial. So try this question at home today. Will you? I have entirely solved. You just have to go and present. Okay? And give me the final answer tomorrow. Okay? So this was your basics. This was your basics. Still in basics, lot many things can be explored. But I have tried to cover the most difficult part over here. Getting my point? In basics, they can give you a question on goodwill. You have purchased goodwill. You have for rupees 5 lakhs in 2011-12. In goodwill for your business or profession. Now that goodwill you are transferring for 50 lakhs. For 50 lakhs. Compute the capital gains. 2 marks, small capital gains can also be asked like this. You have purchased jewelry. You have purchased jewelry. And that jewelry you have sold right now. You have purchased shares, unlisted shares. Based on that, you are getting bonus shares. For the shares, I have already done lot-wise calculation. Yes or no? So now whatever you have understood now, everything will be from there only. You just have to remember that in what concept we have studied this and try to connect it with your question. Flow will remain same. Getting my point? Everyone, I have been telling you again and again. Today also I'll tell you again. If you are learning the things from me, it will be useful only if you solve the questions. If you solve the questions, only then these things are meaningful. Otherwise, you are going to forget it. YouTube channel Umang Thakkar sir, find out all the questions of ICI study material I have uploaded. I am telling you again and again, go and watch those questions. You will get a better idea of the things. I'm trying to cover all the concepts, but I cannot cover all the questions. Getting my point? So, let's move on to the second part of the chapter. We have completed basics. Now we are into specific charge. Okay. Now see, what was there in the basic general charge? General charge 45 subsection 1 says that any profit and gain, any profit or gain, I will write down in short forms so that I can accumulate many things here. Profit and gain arising on transfer of capital asset will be taxable under the head PGBP, no? Taxable under the head PGBP or capital gain, and it will be taxable in which previous year? In the previous year in which chartered accountant is transferred or capital asset is transferred. Capital asset is transferred. This is your 45 one. We have completed this. What is transfer? What is capital asset? How to determine that profit and gain? While determining profit and gain, what full value of consideration you are going to take? What cost of acquisition you are going to take? Period of holding, starting from where, ending from where? What type of capital asset? How much period of holding you are going to see? Everything we have covered over there. Okay, no? Now see, there is one section 45 1A. 45 color green color. So this section says, sir, profit and gain can also arise on receipt receipt of insurance claim. Now, capital asset is not getting transferred. Now, insurance claim is received. Why you will receive insurance claim? Receipt of insurance claim on damage or destruction of your capital asset. And damage or destruction of your capital asset has happened due to NRFE. Natural calamities, riots or civil disturbance, fire or accidental fire or explosion, and E for enemy attack. N for natural calamities, R for riots or civil disturbance, F accidental fire or explosion, F for fire or explosion, E for enemy attack with or without declaration of war. Because of these reasons, because these are the reasons for which you get insurance. These are the reasons which are usually covered by insurance policies. The risk arising due to these things are covered under the under the insurance policies. Insurance company will come. Listen, you have an asset. What if some natural calamity will happen? What if accidental fire or explosion will happen? What if riot or civil disturbance will happen? What if some enemy might attack with or without declaration of war? Your asset is at risk. You will lose your asset. Asset is valuable or not? Very valuable. So if these events will occur, you will incur a loss. Don't worry, don't worry. We are there. Insurance company will say, don't worry, don't worry. We are there. We are going to cover these risks. Because of any of these reasons, if your asset gets damaged or destroyed, we are going to give you insurance claim to cover up your loss. Yes or no? Now, don't you think insurance company would have come to you? You would have got afraid? Yes or no? And you would have taken the policy. And after taking the policy, your asset is under the insurance coverage. And now that asset is damaged or destroyed because of any of these reasons. Now, since your asset got damaged or destroyed because of any of these reasons, will you get something? Will you get something? Yes. Since the asset was under the coverage of insurance, you are going to get insurance claim. How much? Apply some common sense. Insurance company will come and ask you, when did you buy the asset? Oh, 20 years back. Okay. At what cost you bought? 2 lakhs. Take 2 lakhs. Will you accept? Bloody, will you take the insurance of the cost which you have incurred 20 years back? Or you will take the insurance based on the current value? The valuation will be done for the asset. Yes or no? And based on the current value of the asset, the insurance will be offered. What was the cost of the asset? What was the cost of the asset 20 years back? 2 lakhs. What is the value of the asset right now? 20 lakhs. You will take an insurance of 2 lakhs. Or you will take an insurance of based on the current value. Based on the current value. Current value is 20 lakhs. So you might have taken the insurance of 20 lakhs, 18 lakhs, 15 lakhs, whatever amount. But definitely that amount will be higher than the cost. And now, if the damage or destruction will happen, are you going to get amount equal to cost as insurance claim or a higher amount? Don't you think? Because of receiving higher insurance claim as compared to cost, gain is rising. Hello? And that gain should also be taxable under the head capital gain. But since there is no transfer of capital asset, no, so it cannot be taken to general charge. We have to create a specific charge for charging such kind of profits and gains. Hello? Because here extinguishment of asset, no, extinguishment of right in asset is taking place, which is a transfer. So extinguishment of asset, asset is there or not there, asset is gone, damaged or destroyed, asset is gone. So if the asset is not there, your right in the asset is also gone. Extinguishment of right is also a transfer. And on that transfer, are you getting something? What? Insurance claim, which is definitely higher than cost. And as a result of that, gain is arising. That gain also we want to charge under the head capital gain, and which is charged as per section. As per section. Did you understand the entire concept idea? Common sense says, if insurance was not taken, you would have sold the asset at this value. The gain would have happened. Instead of receiving an insurance claim of 20 lakhs, you would have sold the asset for 20 lakhs. The gain would have been taxed, no? Hello? So why there is a problem in paying the tax on this gain now? Just because the asset is gone, that does not mean that gain is not happening. Gain is happening. That gain we want to charge. Sir, but I did not take any insurance. Asset is damaged, asset is destroyed. Did you take insurance? Will you get insurance claim? So no profit or gain will arise. 45(1)(a), charge will not be created. Charge is created. The gain or profit will be taxable only if the insurance is taken and insurance claim is received. This 45(1)(a) charge will be there. Gain will be taxable only if insurance claim is received. Insurance claim is. What if insurance is taken, insurance company has not given claim, rejected my claim? Will there be a gain? 45(1)(a) will not arise only. What if I have not taken the insurance only? Will I get the insurance claim? 45(1)(a) will not arise only. But if I have taken insurance claim and I have received the insurance claim also, I have taken the insurance policy and insurance claim also I have received, 100% there is a gain, and on that gain I have to pay tax under section 45(1)(a). When I should pay tax? When the asset is gone, that time, or when the gain is realized? When the gain will be realized? At the time when the insurance claim is. So the year in which the insurance claim is received, in that year this gain will be taxable, which is different from the year of transfer. Getting my point? So tell me, 45(1)(a), did you understand? 45(1)(a), any profit and gain arising on receipt of insurance claim on damage or destruction of capital asset due to NRFA, and this profit and gain will also be taxable under the head. Now when, in which year it will be taxable? In previous year in which asset is damaged or destroyed. Asset is damaged or destroyed. That will not be good to charge the gains in the year of damage or destruction. Why? Because it is not necessary that insurance claim will be received in the same year. The gain will arise, it will realize in the year in which the insurance claim is received. So that is the year in which the gain should be taxable, and not in the year in which the asset is damaged or destroyed. Will you remember? So it will be taxable in the previous year in which asset is damaged or destroyed? Asset is damaged or destroyed? No. It will be taxable in the previous year in which insurance claim is received. Understood? Now let's take one example. Ready? Should we take one example? That example is nothing but a question which I have framed in the form of an example. You learn how to calculate capital gain in this situation. Okay? Now, let's come to one example. Tang. Ayo. Okay. Sir, where did you frame this example from? I have not framed. One question was there. That question I have arranged in the form of example. Now from the question you are supposed to find out these details. First, sir, there is one immobile property which I acquired on 1st November 2014. Meaning in the previous year, the cost of acquisition of this property was, on this property in 16-17 I did some improvements amounting to rupees 1 lakh. Now this immobile property got damaged or destroyed due to NRFE on, meaning in which previous year? In this year, as on the date of damage or destruction, the fair market value of the property was, they will deliberately give you this. They will try to give as many information as they can give. Understanding? Now tell me, when the asset gone? When the asset gone? 15th of December. Asset is there or asset gone? Asset is there, asset gone. On the date on which the asset is gone, damaged or destroyed, on that the fair market value of the asset was 25 lakhs. Asset going, 25 lakhs coming. Asset going, 25 lakhs coming. Should it be treated as your full value of consideration? What should be taken as your full value of consideration? If you have taken the insurance of the asset, then whatever amount you are going to receive from the insurance company is nothing but amount coming because the asset is going. Common sense. What is coming? This fair market value coming or the insurance claim is coming? Because of insurance claim, because of the receipt of the insurance claim, the gain is happening, and not because of this fair market value, which you are not receiving. Why this is given? Why this collaborative? To confuse you. And you will get confused. You will take this fair market value as full value of consideration. Wow, wonderful. Full marks. Full negative marks. So what will you do with this fair market value? What will you do with this fair market value? Now tell me, did you take the insurance of this property? Question says that it was damaged or destroyed because of NRFE. And fortunately, the assessee took what? Insurance. And the insurance company gave a claim of 24 lakhs. How much? So while giving that claim, it will be seen that the policy was taken for how much amount? As on the date on which the asset is damaged or destroyed, how much loss has been incurred. The valuers will come. They will determine your loss. And based on the loss determination by the valuers, the insurance company will decide the insurance claim. It took some time to determine the loss. And in 2024-25, in my previous year, asset is gone in which previous year? 1920, asset is damaged or destroyed. Actually seeing, I should have got the insurance claim in that year only. But did I get the insurance claim in that year? I got the insurance claim in this year. This is my previous year. 24. Insurance claim received. How much? 24 lakhs. Yes or no? Now this entire case is in front of you. Now, one by one. Asset is damaged or destroyed. Yes or no? Insurance claim received or not received? Received. Because of the receipt of insurance claim, any profit or gain will arise. Any that will be taxable. Under the head? Under the head. In which previous year? In the previous year in which the asset is damaged or destroyed? Or in the previous year in which the insurance claim is received? What is the year of receipt of insurance claim? What is the year of receipt of insurance claim? So, name of the assessee, Mr. X. Individual, ROR, PAN, dash. Previous year? Previous year. In which year you are going to compute your capital gain and charge? 24, 25. Why? Because this is the year in which the insurance claim is received. Yes or no? Previous year? 24, 25. Assessment year? 25, 26. Computation of dash term capital gain. Short term or long term? Depends. Depends on. Tell me, when did you acquire the asset? 1st November 2014. You started holding the asset. This is your start of period of holding. Till what time you were holding the capital asset? You were holding the capital asset till 12th August? Or you are holding the asset till? Can I say this is your period of holding will start from date of acquisition and it will end on date immediately preceding to date of damage and destruction. This is your period of holding. Now check this period of holding. Check this period of holding. You will check 12 months, no? Check no, 12 months. So you will check how many months? Asset is. So for immobile property, how much period of holding you check? Why are you checking 24 months? Because the asset is immobile property. For immobile property, we check how much period of holding? 24 months. 24 months. Old 24 months or new 24 months? Earlier also we used to check 24 months. Now also we check. Depends on date of transfer of capital asset. When is your capital asset transferred? When is your capital asset transferred? Transfer is prior to 23rd July. Transfer is prior to period of holding of immobile property. If the asset is transferred prior to 23rd July, 24 months. Is it more than 24 months? Is it more than 24 months? Everyone, asset is short term or long term? Indexation will be available or not? Sir, but insurance claim? I will give you a tight slap. Asset is transferred on 15th of. Is the date of transfer prior to 23rd July? Indexation will be available. Indexation will be. But if this date of damage or destruction was 15th December 2024, transfer happened on or after 23rd July, then even if the asset is long term, no indexation. But tell me, in my case, the transfer took before 23rd July. Indexation will be available or not? Available or not? Sure. So now, I will calculate long term gain. Number one, full value of asset going. Asset going. What is coming? What is the amount? full value of consideration. In the bracket you will write down under section 45 1A, the amount of insurance claim received will be deemed to be the full value of consideration. Close the bracket, no need to write down any note. Amount column how much? Minus transfer expense. Have you incurred any expense on damage or destruction? Did you incur any expenditure on damage or destruction? No transfer expense. Net consideration 24 lakhs. Net consideration minus cost or index cost? Index cost of acquisition. What is your cost of acquisition? Incurred prior to 1st April 2001 or on or after 1st April 2001? So actual cost will be treated as cost of acquisition. Will it be indexed? Will it be indexed? So while indexing, what we do? We take the cost of acquisition multiplied by CII of year of CII of year of, which is the year of transfer? 1920, the year of damage or you have to be careful. We have the habit of taking the CII of 24-25 because in majority of the question which we solve, the CII of 24-25 we take because the year of transfer is 24-20. Here if you will take the CII of 24-25, you are gone. What is the year of transfer? The year in which the asset is damaged or destroyed is the year of. And bloody we have taken the period of holding from this year to this year only. So year of transfer 1920. What is the CII of 1920? Let's see once. CII of 1920 is 289 is, so 10 lakh cost of acquisition multiplied by CII of 1920, it is 289 divided by CII of year of acquisition. CII of year of, what is the year of acquisition? 1415. What is the CII of 1415? What amount you are getting on your calculator? What amount you are getting on your calculator? Okay. So 24 was your net consideration minus index cost of acquisition 12 lakh 4,167. Hello sir. But wait. Did you have any cost of improvement? This cost of improvement, will you reduce the cost of improvement while calculating your capital gain? Yes. Because the cost of improvement is incurred on or after 1st April 2001. So what was your cost of improvement? To be indexed or not to be indexed? This also to be indexed. So take 1 lakh multiplied by CII of which year? Transfer year. CII of, what was the transfer year? Into 289. 289 divided by CII of which year? Improvement year. So what is the CII of improvement year? 264. So into 289 divided by 264. 1 lakh 9,000. From your 24 lakh, reduce index cost of acquisition, index cost of improvement, how much you are going to get? This is your taxable long-term capital gain. Taxable. And this amount will be taxable in which year? In the year of damage or destruction, no? 1920, no? This gain is happening on receipt of insurance claim. And insurance claim is not received in 1920. Insurance claim is received in 24-25. So this gain will realize in 24-25. This should be taxable in the year 24-20. Hence, in the format above, you have written previous year 24-25 assessment year. So this gain is going to be taxed in which year? In the year in which the insurance claim is received. 24-45 one done. Understood? Easy or difficult? Made easy. So 2 to 3 things you are supposed to remember here. 2 to 3 things you are supposed to remember. See, any profit or gain arising on receipt of insurance claim on damage or destruction of capital asset due to NRFA will be taxable under the head because of specific charge 45 1A, and it will be taxable in the previous year in which insurance claim is Received. Not taxable in the year of transfer, taxable in some other year. And in this year, to calculate the capital gain, full value of consideration. What will be the full value of consideration? The amount of insurance claim will be deemed to be the full value of. First thing you will remember. Number two, period of holding of this capital asset will be taken from date of acquisition till the date of damage or destruction. That will be the period of holding. Based on that period of holding, if the asset is short term, cost of acquisition, cost of improvement without indexation, yes or no? And based on that period of holding, if the asset is long term, cost of acquisition, cost of improvement, both will be indexed if the damage or destruction was prior to 23rd July. And if the damage or destruction was on or after 23rd July, no need to give any indexation. But remember, if you are indexing, indexation should happen from year of acquisition to year of damage or destruction, year of improvement to year of damage or destruction. So whenever you will take cost of acquisition and cost of improvement multiplied by transfer year CII divided by acquisition or improvement year CII, acquisition or improvement year CII will not change, but the transfer year CII will be the CII of damage or destruction year. That year CII you are supposed to multiply. Don't commit mistake here. Will you remember this? 45 on a done. Now 2 to 3 small points I want to ask you. First question. In your business, you might have stock in trade. Damaged or destroyed? Damaged or you receive insurance claim. Will that insurance claim be taxable here? Why? The amount received on as insurance claim on damage or destruction of a capital asset will be taxable here under 45 1A. What is damaged or destroyed? What is damaged or destroyed? Is it a capital asset? So insurance claim on damage or destruction of your stock in trade will not come here. 45 1A will not be calculated. That insurance claim will go to PGBP. It will be treated as your deemed PGBP income. Amount of stock lost will be loss allowed under the head PGBP. Against that loss, insurance claim is received will be your deemed PGBP income. First point, did you understand? Second point. You have some assets which are used in business or profession. Let's take one example. This projector is used in business or profession. Yes or no? Asset or stock in trade? Business is not to buy and sell projectors. Business is coaching business. In this coaching business, this asset is asset used in business, valuable asset. So we have taken insurance also. We have taken, first of all, cost of this asset was 50,000. How much is the cost? How much is the cost? Is it an asset used in business or profession? Question is it a capital asset? Is it a capital asset? Yes. Asset or property of any kind. Tangible, intangible, movable, immovable, fixed, circulating. All the types of asset. Whether used for my business or not. It is my. But since this capital asset is helping me to earn my business income, I am not keeping this asset in capital gain side. Where is this asset? In my business side. There will be a block. There will be a block of this asset. In that block, the asset is there. Cost of 50,000 is there in that block. Now this asset damaged or destroyed. An insurance claim is coming. This is going as a capital asset, or this will go from my business, from my block? Asset is coming in the block, addition. Asset is coming in the block, addition. 50,000, yes or no? But now the asset was there in the block, damaged or destroyed. So it will remain in the block or it will go out of the block? Addition or deletion? Insurance claim received will be adjusted as deletions from the value of the block. 45(1)(a) not to be calculated. Are you able to, visualize? Asset was there in business, in my block. So the cost of this asset was there in the block. So any recovery against this cost has to be adjusted from the value of block. So asset is added in the block at 50,000 cost. So the 50,000 cost is included in the value of block. Now this asset damaged or destroyed going from the block, meaning deletions. So asset damaged or destroyed. Asset used in business or profession, damaged or will be treated as deletion. Will be treated as from the block. And any amount of insurance claim received on such damage or destruction will be automatically adjusted from the value of block. To the extent the value will reduce. To that extent you are not going to get depreciation. Will you remember? Will you remember? Now the asset is not a stock in trade. Asset is not a stock in trade. Asset is not used for business or profession. It was your personal asset. Not a movable personal effect. It was your personal effect. Personal asset. It is your capital asset. And if that asset is damaged or destroyed, and insurance claim is received, only then 45(1)(a) will arise. Getting my point? Only then the profit and gain will be taxable under the head capital gain. Every time whenever you will get insurance claim, don't run in this head. Every time insurance claim will come, 45(1)(a) will not arise. 45(1)(a) will arise only if insurance claim is received on transfer of a capital asset. Transfer of a capital asset by way of damage or destruction. And insurance claim is received. What it, sir? 45(1)(a) over. This thing I was explaining. Insurance claim is received on damage or destruction of stock in trade, depreciable asset forming part of block, and any other asset which is my capital asset. Here only 45(1)(a) will come. Insurance claim will be taxable under the head capital gain. Here 45(1)(a) will not come. Why? Because the entire insurance claim will be adjusted from the value of the block. Remember the example of this projector. Yes or no? The stock in trade, damage or destroyed, insurance claim will come. That insurance claim will be treated as my DMPGBP income. Even that will not come under 45(1)(a). Done, sir? Should I move ahead? Let's go to next section. Next section is, sure, next section is 45(2). 45(2). Profit and gain. Again, a profit and gain will be taxable here. Again, a profit and gain will be taxable here. And now the profit or gain on conversion of chartered accountant into special investigation team. No, capital asset into stock in trade. So, what is the asset? Capital asset. It is there with you? Yes. Now, you were treating that asset earlier as your capital asset. After some times, you said, no, macha, from today you are my stock in trade. Earlier, you used to call him, you are my capital asset. You are my... But all of a sudden, you started calling this asset. No, from today you are my... Possible or not? Asset is leaving you, but is still with you. Asset is leaving you, or is still with you? Still the profit or gain will arise on this conversion. Because at the time when you bought the asset as capital asset, the value was 1 lakh. The value was, and today when you are converting it as a stock in your business, the value of this asset is 1 lakh 50. How much appreciation in the value? That 50,000 should be taxed under the head capital gains. And it is possible only if the profit or gain is charged separately as per specific section. Don't worry. Full example I have. One question converted into example. You solve that question, you will come to know that it is so easy. First of all, you have a capital asset. Now you are converting that capital asset into. So you started a business, and in your business you converted this, started treating this as the stock in trade in your business. Yes or no? Now the conversion of capital asset into stock in trade, on this conversion, whatever profit or gain will arise, even that is also taxable under the head capital gain, and it will be taxable in the previous year in which capital asset is converted into stock in trade? No. Because on this conversion, the gain will not realize. Whatever gain is happening on this conversion, that gain will not come in your hands on conversion. It will come in your hands when the asset will be sold as what? Stock in trade. So that time when this gain will realize, that time when this gain will come in your hands, at that time this gain will be taxable. Yes or no? So this gain will not be taxable in the year of conversion, but it will be taxable in the previous year in which stock in trade is converted capital asset is sold as stock in trade. So that stock in trade is sold. Will you remember this? Now to calculate this capital gain, what all things we are supposed to do? Yes or no? So do one thing. Let's take one example. This is your section. Any profit and gain arising on conversion of capital asset into shall be taxable as income under the head as per specific charge. It will be taxable as your capital gain income in the previous year in which capital asset is converted. No. In the previous year in which converted capital asset is sold as stock in trade. It is sold as stock in trade. In that year the gain will be taxable. Now sir, to understand this, let us take this example. Question only. Converted into example. Now see what details are given in the question. There is one assessee. The name of the assessee Mr. XYZ ABC, whatever. He acquired some shares. Let's assume that the shares are unlisted shares. Which shares? And he acquired these shares on 12th of November 2000. Sir, where did you get this date? Every detail which is there will be in question. You just have to pick up these details and arrange in this order. You will never go wrong. Okay. So when the shares are acquired, that time you had some money which you invested in shares. So if you have money, you have invested in shares. What was your intention? For appreciation. Very good. You wanted that your money which you have invested in shares should appreciate. Appreciation was the intention. With that intention, if you have bought the shares, so the shares were your stock in trade or it was your capital asset. So you acquired the shares as capital asset. So at the time when you acquired the shares, they were your capital asset on 12th of November 2000, meaning previous year. What was the cost of the shares? 1 lakh. Yes or no? Now what is happening? On 11th of December 2020, you started a share trading business. So you'll buy shares, sell shares, buy shares, sell shares. Now whatever shares you are buying will be your stock in. Whatever shares you are buying to sell will be your stock in trade. But instead of buying new shares as your stock in trade, you said that let's convert my capital asset as a stock in trade in my business. So you brought these shares in your business, share trading business as your. So you might have made your books of accounts of business. In that books, contribution, I will have to contribute in my business some capital. So what I will bring in my business? Cash I will bring. I will bring some assets also. Yes or no? So I am bringing 5 lakh rupees of cash. Cash account debit to proprietor's capital account. Then I am bringing some assets which I will be selling as stock in trade or which I will be using for my business. Yes or no? So I will bring those assets. Assets account debit. Assets account debit to capital account. So from my capital, I converted some assets in my business. I passed journal entries. I passed entries in my books. On what date? On what date? On this date, I took these shares in my business. I started treating them as my stock in trade in my business. On this date, the value of the shares was, don't you think, the capital which I invested has appreciated by 50,000, and as on the date of conversion, my shares are worth 1,50,000. Yes or no? Now, if I would have sold these shares as capital asset, if I would have sold these shares on this date as my capital asset, 50,000 gains would have been taxable under which head? Capital gain. Because that 50,000 gain is for the period for which the shares are held as capital asset. Now the shares are becoming, and on the date on which they are becoming stock in trade, what is their value? 1 lakh. Now these shares I am selling in 24 as my stock in trade. For how much? So now the shares are coming as stock in trade. Now the shares which are stock in trade, what is the value at that time? Now I will start holding the shares as stock in trade. Now this stock in trade, the value will appreciate and the value will become 175. At that time I am selling. What is the appreciation in the value? And don't you think this appreciation in the value has happened after I started holding them as? This appreciation should be taxable under the head PGBP. This appreciation should be taxable under the head. Getting my point? This appreciation should be taxable under the head. Simple thing, no? What a layman will think. What was the cost of the shares? What was the cost of shares? And for how much it is sold? What is the total gain? But that total gain of 75,000 will be realized at the time when the shares are sold. When the shares are as? So if the shares are sold as? If the shares are sold as? So entire 75,000 should be taxable under PGBP. Entire 75,000 should be taxable under the head PGBP. That is wrong. Because out of that 75,000, only 25,000 gain relates to the period for which the shares were held as So only 25,000 should be taxable over there. Out of that 75,000, 50,000 gain relates for the period for which I was holding the shares as capital asset. That should not be taxable under the head PGBP. That should be taxable under the head. Getting my point? Understood? No? Now to do that, what will happen? In the year in which the shares is, two statements will be prepared. Two statements. Statement to calculate PGBP income, statement to calculate capital gain. Because the gain, the appreciation relating to this period has to be taxed under the head. And the appreciation relating to this period has to be taxable under the head. Entire appreciation, if taxed under the head PGBP, will be wrong. Because how the bloody hell you can charge something under the head PGBP, which is relating to your capital asset? Getting my point? So, in which year the shares are sold? Come on, tell me. 24. They are sold as? So, the year in which the converted shares are sold as what? Stock in trade. In that year, two statements will be prepared. First statement, PGBP. Second statement, and this capital gain statement will be prepared. In this, the capital gain will be computed and will be taxable as per 45(2). As per 45, profit or gain arising on conversion will be taxable under the head capital gain in the year in which the stock in trade is sold. Got it? So first statement we will prepare PGBP. Come on, let's prepare the statement of PGBP. To calculate PGBP, we'll take the selling price of stock in trade. My income is what? Selling price of stock in trade. What is the selling price? So this will be my selling price of stock in trade minus the purchase price of my stock in trade. Yes or no? What is the purchase price of my stock in trade? Bloody, if you will take 1 lakh, no, you are gone. If you will take 1 lakh, you are gone. Why? Because that 1 lakh is not the purchase price of my stock in trade. That 1 lakh is the purchase price of my capital asset, will be reduced as cost of acquisition while calculating my capital gain. So this stock in trade, did you purchase or capital asset got converted into stock in trade? And as on the date on which it was converted, what was the value of these shares? If the shares were not there with you and this stock in trade you would have bought from the market, how much cost you would have incurred? That should be treated as cost of your stock in trade. That should be treated as cost of your stock in trade. Supreme Court judgment. I'm not getting into detail. I'm just telling you logic wise. Okay. So tell me, to calculate PGBP, what will be my income? Selling price 1 lakh, and I have to reduce the cost of my stock in trade. What is the cost of my stock in trade? If the capital asset, if the shares were not there as capital asset, as on the date of conversion, as on the date of, I would have bought these shares as stock in trade for how much? This will be deemed to be the cost of acquisition. Sorry, this will be deemed to be the cost of my stock in trade to calculate my PGBP. So that only the gain relating to the period for which the shares are held as stock in trade should be taxed under the head PGBP. Yes or no? So, fair market value as on the date of shall be deemed to be, shall be cost of my stock in trade, cost of my, to calculate PGBP income. So tell me, 1,75,000 minus how much will be my taxable PGBP? So that PGBP will be taxable in which previous year? So in the previous year 24, 25. In the previous year, your PGBP income will be, let's go to the chart again. Now tell me, how much gain is relating to this period for which the capital asset is held? So this 50,000 should be taxable under the head. It is possible only if cost of capital asset is 1 lakh and the selling price, full value of capital asset is 1,50,000. Full value of consideration is 1 lakh. Apply common sense. If on the date of conversion, you would have sold the capital asset, you would have sold the, how much amount you would have received? Don't you think that should be your full value of consideration? So the amount of fair market value as on the date of will be treated as cost to calculate your PGBP, will be treated as cost to calculate your, this same amount will be treated as full value of consideration to compute your capital gain. Common sense. One amount, double roll. One amount. To calculate PGBP, it will be treated as your cost. Cost of stock in trade. But to calculate your capital gain, this same amount will be deemed to be your full value of consideration under section 45(2). Under section, and based on this fair market value, your capital gain will be determined, which will be 1,50,000 minus 1 lakh. 1,50,000 minus 1 lakh will be how much? 50,000. That 50,000 gain also realized in the year of conversion? No, in the year of sale of stock in trade. So this 50,000 will be taxable in the year of sale of stock in trade. What it, sir? So tell me, if you want to calculate capital gain under section, so this capital gain will also be calculated along with your PGBP income. In which year? In which year? In the previous year in which shares are sold as, and that was the previous year 24-25. So in the year 24-25, PGBP income will be 25,000. So your capital gain income should be 50,000, no? And to do that, this entire amount of cost, this entire amount of will now be treated as your full value of consideration to calculate your capital gain. So what is your full value of consideration? 1,50,000 minus transfer expense. When the transfer took place? Conversion. Capital asset converted into stock in trade is a transfer as per 2 subsection 47. Do you remember the definition of transfer? Capital asset converted into stock in trade. That conversion is also a transfer. So when the conversion is taking place? 2021. On this conversion, what is the amount coming? 1,50,000. This is your full value of consideration minus any transfer expense. Any expenses on conversion? No. So transfer expense 0. What will be the net consideration? 1,50,000 minus cost of acquisition, and if any cost of improvement was done, I would have reduced the cost of improvement also. But in my question, there is no cost of improvement. So I will reduce only cost of. Now cost of acquisition with indexation or without indexation? Depends. Depends on period of holding. So I started holding the capital asset from, and I held the capital asset till the date of conversion, because after that it is no more my capital asset, it is. So will I include this period in the period of holding of capital asset? So I will include only the period starting from date of acquisition till the date of, this is the period of holding of my capital asset. This is the period of holding of my, starting from and ending on. Hello sir. Now look at this period of holding. How much period should I consider? 12 months, 24 months, 36 months. Depends on the type of asset. What asset it is? Shares. Shares. Listed or unlisted? I will check how many months. Wait. Transfer takes place as on the date of conversion. Date of conversion is the date of transfer. Date of conversion is the date of prior to 23rd July on or after 23rd July. So conversion takes place prior to 23rd July means transfer takes place prior to 23rd July. Yes or no? And in this case, period of holding of unlisted shares if the transfer takes place prior to 23rd July will be checked 24 months. Sir, if the transfer would have taken place after 23rd July also no, then also I would have taken 24 months. But since the transfer takes place prior to 23rd July, I will check the period of holding 24 months because the shares are unlisted. So tell me, is the period of holding more than 24 months or less than 24 months? Asset is short term or long term? So under section 45(2), capital gain calculated will be short term gain or long term gain? Long term gain. To calculate this long term gain, you have cost of acquisition. Will you index it? Why? Because the transfer takes place prior to. Indexation will happen. So how will you index? You will take cost of acquisition multiplied by CII of in which year the capital asset is transferred. The year of conversion is the year of transfer. So year of transfer is so CII of which year? 2021. CII of 2021. Let's check. CII of 2021 is 301. So 1 lakh into CII of transfer year 301 divided by CII of which year? CII of acquisition year. And what is the acquisition year? 17. It is 272. So into 301 divided by 272. How much index cost you are getting, sir? 1 lakh 10,000. Yes or no? Sir, 1,10,662 is the index cost. Why are you indexing? Because the conversion, because the transfer takes place prior to, and the period of holding is also more than 24 months. Asset is long term, transferred prior to 23rd July. We are indexing the cost. Yes or no? Now, was there any cost of improvement? If the improvement cost was there, we would have indexed that also. And that you know, cost of improvement multiplied by CII of transfer year. CII of transfer year 301 divided by CII of improvement. The year in which the improvement was done, for that year I would have, divided the CII. Understanding or not what is happening? Sure. So no cost of improvement, so no index cost. This minus this, you are getting? Sir, but you were saying that the gain for this period is how much? How much should be taxable under capital gain? But sir, only this much is getting taxable. Why? Because out of 1,50,000, no, you did not deduct 1 lakh, you index that cost. And as a result of that, cost of acquisition got increased. And hence, entire 50,000 is not getting taxed. Only a part of that 50,000 is getting taxed. But ultimately, that 50,000 is getting taxed here. Getting my point? Hello. This gain cannot be taxed. This gain cannot be taxed under the head PGBP. For the purpose of taxability of this gain under the head capital gain, section 45(2) is there. Will you remember this? Sir, 24-25 is gone and still these shares are not sold. This will come only in the year in which the converted capital asset is sold as. And why we are calculating here? Because in 24-25, the converted capital asset is sold as. So in that year, PGBP income will also be taxable and the gain under section 45(2) will also be taxable. Will you remember this? Sure? 45(2) done. So what important thing you are supposed to remember? Whenever you are going to calculate gain under section 45(2), what full value of consideration you will take? The fair market value as on the date of which you took as cost to calculate your PGBP income. Yes or no? that same amount of fair market value will be treated as full value of consideration. Okay. Period of holding you will take from date of acquisition of your capital asset till the date of transfer of your capital asset. When the capital asset was transferred? On the date of conversion. After that, any period if you take, you are gone. Because after that, the asset is not held as capital asset. It was held as capital asset till the date of conversion. So your period of holding till the date of conversion. If this period is short term, if this period is cost of acquisition, cost of improvement without indexation, and if this period is long term, both cost of acquisition and cost of improvement will be indexed. Both cost of acquisition and cost of improvement will be indexed. Yes or no, sir? But indexation will come only if conversion, transfer happens prior to 23rd July. If the conversion, if the transfer takes place on or after 23rd July 2024, even if the period of holding is more than 24 months, more than 12 months, more than 36 months, more than 12 months or more than 24 months, even if the asset is long term, you are not going to do any indexation. Without indexation, cost of acquisition; without indexation, cost of improvement. Will you remember this? Sure. Now I will test your knowledge. Pay attention, huh? Very important thing I am asking. Logical also. I wish that you should give me the answer. What you had? What was the cost? Cost of capital asset was? It was converted into? So as on the date of conversion, the fair market value was how much? And this stock in trade is sold. Stock in trade is, and at the time of sale, what was the selling price? This is the cost of your capital asset, cost of acquisition of your capital asset. This capital asset got converted into stock in trade and it was sold as stock in trade. As stock in trade, it is sold for how much? Yes or no? So for tell me, appreciation for this period, it should be taxed as what? So it will be taxed under? Yes or no? Under the head capital gain. Appreciation for this period to this period is 25,000. Yes or no? This should be taxed as your capital gain or PGBP. So this was taxed as your PGBP. Yes or no? To do this, what you did? You took this amount as cost of stock in trade. Yes or no? And this amount you took as full value of consideration for capital gain. Full value of consideration for done, no? Hence, this 50 will be taxed under the head capital gain and this 25 will be taxable under the head PGBP. This was the logic. This was the entire idea. Now tell me, if you have, now you have capital asset or you have purchase price of stock in trade. Cost means purchase price. Now the stock in trade is converted into and as on the date of conversion, the fair market value was 1,60,000. Let's separate, no, some new example, 1,60,000. Now this capital asset will be transferred and the capital asset was transferred. The consideration for transfer was 2 lakhs. Was? Give me your answer. From this period to this period, the asset was held as? What is the appreciation? This appreciation should be taxable under the head. Sure. From this period to this period, the appreciation is? And this appreciation should be taxable under the head. Because for this period, the asset is held as? Capital asset. Hello? Right? What is this? Take this as cost of acquisition of your capital asset. And take this amount as income to compute your PGBP income. So 1,60,000 minus will be taxable as in which year? In the year in which the capital asset is transferred. Capital asset is sold. Bloody, this was your stock in trade. Now you have converted into, when will you sell? 5 years, 10 years, and maybe you don't sell only. So till that time the government will wait to charge tax on this 60,000. No. In the year of conversion, in the year of, this entire amount will be taxable as your PGBP. In the year of conversion, this entire amount will be taxable as your, and how that is possible, I'll tell you. The fair market value. The fair market value of your inventory, of your stock, as on the date of its conversion, as on the date of its into capital asset, as per section 28, it will be taxable as your PGBP income. I did not tell you the entire income, I did not explain at that time. If you remember my PGBP head, which we did 50,000 years ago, two types of charge: general charge, specific. In specific charge, there were some specific incomes: compensation or modification, or termination of some agency contract, then managing agent contract, then export incentives was there, then partner is receiving interest. Those specific incomes we charge. Last income, I told you, last income, the list of income which is taxable only under the head PGBP, in that list last income was this: the fair market value, of the inventory, of the stock in trade, as on the date of its conversion, as on the date of its, that fair market value will be treated as your PGBP income as per section 28, and it will be taxable. It will be taxable as your PGBP income in which year? In the year of sale of your capital asset, or in the year of conversion? In the year of conversion itself, it will be treated as your income. It is an income against that stock in trade which was costing how much? 1 lakh. So income is 1,60,000. It is against that stock which was costing. So 1 lakh minus 1 lakh, sorry, 1,60,000 minus 1 lakh. This entire 60,000 gain will be taxable under the head in the year of conversion itself. We are not going to wait for charging this gain at the time of sale of this asset as, bloody, you might not sell that asset as capital asset. So forever this 60,000 is gone. Forever on this 60,000 will not be able to charge tax. See, the reverse is not possible. Both the gains are taxable in the year in which the asset is sold as. Why? Stock in trade is a fast moving item, bloody. And the moment you have converted your capital asset into stock in trade, very soon it is going to be realized. Very soon this gain will also be realized and this gain also be realized. So both the gains, whenever it is realized, because the asset is now becoming your stock in trade, very soon this gain will realize. At that time we'll charge tax, because the asset has now become stock in trade. Stock in trade is not slow moving item, it is a fast moving item. The moment it has become stock in trade, now fastly it will be sold, and fastly the entire gain will come in your hand, and both the gains will charge tax at that time. No problem in that. But here, it was a fast moving item. You converted into slow moving or non-moving item, capital asset. Now when you will sell it? After 1 year, after 2 years, after 5 years, or maybe forever it is not sold. So just imagine, both the gains will be taxable at the time of sale of capital asset. Is not in the interest of the government. You pay the tax on your capital gain, capital appreciation, when the capital asset is transferred, but pay the tax on this gain arising during the holding period of stock in trade. Pay the tax on this entire gain in the year of conversion. And to do that, what they have done? This entire fair market value as on the date of will be treated as your PGBP income. Under section, specifically this amount will be treated as your PGBP income. In which year? The year in which the stock in trade is converted into same year. This 1,60,000 will be taxable as your PGBP income. Now to earn this PGBP income, the stock was there. What was the cost of the stock? 1 lakh. So reduce that cost, you will get a profit. Profit of 60,000 will be taxable under the head PGBP. Will you remember this? Now, how much more gain is there? And that will realize at the time of this 60 will also realize at that time, 40 will also realize at that time when the capital asset is transferred. Don't you think? At the time when both the gain will be realized at that time, both the gain should not be taxable. Only 40,000 should be taxable at that time, because out of the entire gain of 1 lakh, 60,000 gain is already taxed right now in the year of conversion. Now whatever gain which is for the period for which the asset is held as capital asset, only that gain should be taxable under the head capital gain. Yes or no? Yes or no? So when the capital asset is transferred, example, it is transferred after few years. Whenever it will be transferred, whenever it will be full value of consideration, full value of consideration 2 lakhs minus transfer expense, nothing. Net consideration 2 lakhs. What will be the cost of acquisition? What will be the cost of acquisition? The fair market value as on the date of conversion, which you have already considered as income under the head, shall be deemed to be the cost of acquisition of this asset. No other amount you can take as cost. Here the cost of acquisition is not actual cost of acquisition. Here the cost of acquisition is not 55(2)(a), 55(2)(AA). Here a notional amount will be deemed to be your cost of acquisition. What is that notional amount? The fair market value as on the date of shall be deemed to be the cost of acquisition of this type of capital asset. Have you acquired this capital asset? Have you acquired this capital asset? No. This capital asset was not acquired by you. This capital asset came to you, became your property on conversion of stock in trade. Special scenario. The asset is coming to you as capital asset. If you would have acquired, no, we would have taken actual cost. Have you acquired this asset as capital asset? No. You acquired the asset as stock in trade, and on conversion of that stock in trade, the capital asset became your property. On conversion of capital asset, on conversion of stock in trade, the capital asset became your property. So what cost of such type of capital asset you will consider? The fair market value as on the date of conversion shall be deemed to be, cost of such type of capital asset. This type of capital asset will not have actual cost as cost of acquisition, 55(2) as a cost of acquisition. Special amount, notional amount will be treated as Cost of acquisition. Got it, sir? So what will be the cost of acquisition? 1 lakh? Wait. To be indexed or not to be indexed? Depends on period of holding of the will start from common sense, the date on which it was converted into, the date on which the stock in trade was converted into. From that date you are holding this capital asset. So holding period will start from date of conversion and it will end on the date of transfer. And if that holding period is less than or equal to 12, 24, 36 as the case may be, then the asset is short term. Cost you have how much? 1,60,000 without indexation. And any cost of improvement incurred later on, any cost of improvement, the cost of improvement will happen here, the cost of improvement will happen here, will be considered for capital gain, and any improvements done here will be considered for PGBP. Getting my point? So if any cost of improvement is there and cost of acquisition will be there, will be without indexation, because the period of holding is, tell me, the period of holding is how much? From this to this. During this period of holding, if this period of holding less than equal to 12 months, less than equal to 24 months, less than equal to 36 months, as the case may be, depending on the type of asset. Yes or no? Asset is short term. Asset is, but remember, period of holding you have to start from this. You'll have to end on this. Done. Short term, then cost of acquisition. Cost of acquisition 1,60,000, or any cost of improvement will not be indexed. But based on this period of holding, based on this, which was more than 12 months, more than 24 months, more than 36 months, depending on the type of asset. Yes or no? Asset is? So what is the cost of acquisition? What is the cost of improvement? Will be indexed if the transfer date is prior to 23rd July, and if the transfer date is on or after 23rd July, even if the period of holding more than 12 months, more than 24 months, no indexation benefit will be available. Why? Because the date of transfer is after 23rd July. Will you remember all these things? Sure. Just imagine if I would have told you this funda, that this amount will be treated as your income under the head PGBP. That time you would not have, loved this, liked this concept. That's why this concept I took later on, along with 45 too, so that you understand what is happening, why that amount is getting taxable under the head PGBP. This fair market value will be treated as your income under the head PGBP. Income minus cost will give you PGBP, and the same amount will be treated as your cost to calculate your capital gain. Capital asset, period of holding will be from the date of conversion till the date of, this will be your period of holding of capital asset. Yes or no? And if based on this period of holding asset is short term, no need to index the cost. And if based on this period of holding asset is long term, you will index the cost, provided the asset is transferred, capital asset is transferred prior to 23rd July. And if the capital asset is transferred on or after 23rd July, even if the asset is long term, no need to do indexation. Done, sir? Done, sir? So this was your 45-2, and this entire concept just now I explained. Okay? And I have written it in a beautiful, presentable manner. The moment you will start reading these notes, everything will come in your mind. Okay? Okay, sir? Okay? Last section. Last. No. Last section for today. This is second part. Okay? 45. 5. In between, no, there are few questions which are solved. Okay. If the facts of that question are not available, no, forget those sections. Okay, no, forget those questions. Sorry, don't forget the sections. Okay, now next one is 45, 5. So please pay attention. Color, pink color, no? Okay, let's take pink color. 45, 5. 45. Now 45, 5 also talks about profit and gain. Profit or gain on compulsory acquisition of capital asset under any law. So if compulsory acquisition is taking place of your capital asset under any law, so on this compulsory acquisition also the profit or gain will arise, and that profit or gain will be taxable. Taxable under the head capital gain. In which previous year? In previous year in which capital asset is compulsorily acquired. No sir, not in this year. The year in which the asset is compulsorily acquired is not the year in which the gain will be taxable. Rather it will be taxable in the previous year in which amount of initial compensation is received for the amount of initial compensation or any part thereof, is received for the first time. And along with this profit and gain on compulsory acquisition, yes or no, there is one more amount which is taxed under 45(5). But let me explain this. Once I finish this explanation, that part also I will include. Pay attention. Profit or gain will arise because your capital asset is compulsorily acquired. Capital asset is taken away from you. Where is my asset? Gone. Who took the asset? Why? Because the road is there. The government wants to broaden the road. Hello? So how the roads will be broad? Because there are many shops, many buildings on the side of the road. So take your building a little bit back. Take from back. No, it is not possible. So what they are going to do? They are taking all the shops and buildings which are on the side of the road. They will break it and they will broaden the road. Yes or no? Or railways there. One railway track has to be laid. But your building or your land is coming on the way of this track. What will you say? Take the track like this. So for you, they will change their entire plan. So if you will tell them, take from this side, somebody else's land will be there. No, not from this side, take from that side. Somebody will have to give their land, to lay that railway track. Yes or no? So railways will show you that map. See, on this map, we are laying the railway track. And while laying the railway track, see, here exactly your land is falling. And from your land, we are supposed to take our railway track. Take it from up, not possible. Take it underground, not possible. We want to take it from your land. So give me 50,000 rupees per train passing. You're going to tell these kind of bullshit. No, give us your land. I don't want to give. This is my ancestral land. Bullshit. What? Bullshit. What is the value of your land? 50 lakhs. Give me 5 crores. Bullshit. Under the law, okay, they are empowered to take away your assets. Government authorities, they are empowered to take away your assets in the public interest, general public interest. So in the general public interest, they will throw you out. Get out. But my asset, get out. But my asset, get out. How much you bought the asset for? When did you buy the asset? 10 years back. How much you bought it for? What was your cost? 5 lakhs. Take the 5 lakhs and go away. This is not good. This is, see, you are throwing us. We are not saying anything because you are throwing us as per the authority given by any law. But you cannot do this injustice. Pay us fair amount of compensation. So whenever that fair amount of compensation will be given, that will not be equal to the cost of your asset. The value of that asset will be, yes, value of that asset will be considered. Existing value of that asset will be considered. Existing fair market value. And on the basis of that, the compensation will be decided. What was the cost of your asset? 5 lakhs. When did you incur that cost? 10 years back. 10 years back. Today, at the time of compulsory acquisition, what is the value of your asset? Example, that value of the asset is 25 lakhs. What? So the government will keep in mind that the value of asset has increased. Value of asset has, and accordingly they will decide a fair amount of compensation, which was only 19 lakhs. Government, no. You cannot go and tell them, value was 25, give me 25. We are government. Why they give you less, you know? Even if they'll give you the exact amount of market value, no, still you will be dissatisfied. And still you are going to file a case against the government for enhancing the compensation. They know that even if we'll give, this fellow is going to go to the court for increasing the, in the beginning only, give him less. Anyways, he is going to go to the court for increasing the compensation. So that way we will be able to save some money also. Yes or no? So how much the government is going, how much initial amount of compensation the government has decided? 19 lakhs. We are going to give you. It is decided. Given or not yet given? Compulsory acquisition took place. Compulsory acquisition took place. Asset is gone. Transfer happened. But in that year, the gain will not be arising and it will not be taxable. The gain will arise on receipt of the full amount of initial compensation or any part of the initial compensation. How much was the initial compensation? Don't you think that the government is not going to give you that full amount straight away? Sometimes they give you in installment. Take 9 lakh rupees right now. Balance 10 lakh next year. Compulsory acquisition happened right now. Did they give you money right now? After few years they are going to give you money. But that money is also not full. Some part they will give. So the year, what did I say? The year in which the initial compensation or any part thereof. The year in which the initial compensation or part thereof is received for the, for example, if I say that immobile property you acquired in, your capital asset you acquired in, for how much? 10 lakh. You incurred some cost of improvement also, and this was compulsorily acquired by the government in 22. At that time, the fair market value was, are you getting this from the government? Then why it is given? Confusing. At the time when the asset was compulsorily acquired, at that time, what was the value? What was the value? 30 lakhs. No. Are you getting that 30 lakhs? Government has promised an initial compensation of, keeping in mind the market value, they decided that 28 lakhs. How much you are going to get? How much you are going to get? And out of that 28 lakhs, 18 lakh was received in my previous year, 24, and 10 lakh is still 10 lakh is still that you are going to receive in future. Now tell me, which is the year in which the compensation or initial compensation or part thereof is received for the first time? 24. In this year, 45.5 will arise. In this year, now you will calculate the capital gain under section 45.5. What will be the full value of consideration? Will you take 18 or you will take 10? If you will take 18, no, that is not full value. If you will take 18, that is not full value. That is the part of the value which you are going to receive. To compute capital gain, what you want? Part of the value or full value? So which is the full value? Entire 28 lakhs will be taxable in which year? Entire 28 lakhs will be taxable in which year? The year in which the amount of initial compensation or part thereof is received for the first time. This is the full value of consideration on transfer of your capital asset, because compulsory acquisition is also a transfer. Getting my point? So what will be the full value of consideration? What will be the full value of consideration? 28 lakh. 28 lakh minus transfer expense. Any expenses which is incurred at the time of compulsory acquisition for transferring your asset to the government will be treated as your transfer expense. But in our case, there was no transfer expense. Yes or no? So what will be the net consideration? 28 lakh minus cost as well as index cost. With indexation, cost as well as cost of improvement. With indexation or without indexation? Depends. Depends on. So what was the period of holding of the capital asset? 18th December 2009 to the date of its compulsory acquisition. For this period only you were holding the capital asset, no? So this is the period of holding. This is the, now tell me, period of holding. Transfer happens on the date of compulsory acquisition is the date of transfer. This date is prior to 23rd July or on or after 23rd July 2024. Prior to, meaning old period of holding. Yes or no? For immovable property. Earlier we used to check period of holding of 24 months. Now also we are checking 24 months. Earlier also we were checking. So now tell me, is this period of holding more than 24 months? More than? Asset is? And indexation benefit will also be available. Do you have cost? Multiplied by CII of which year? CII of 22-23. So what is the CII of 22-23? Let's see. CII of 22-23 is 331 divided by CII of acquisition year 910. What is the CII of 910? 148. So multiplied by 331 divided by 148. How much is the index cost? How much is the index cost? 22,36,486. Are you getting this? Everyone? Now, wait. Was there any cost of improvement prior to the transfer? Yes. Prior to the compulsory acquisition, there was a cost of improvement amounting to 2 lakh. This cost of improvement happened in 13-14. So this cost of improvement will also be indexed. Hello? You will take 2 lakh multiplied by CII of this year. CII of this year 331 and divided by CII of 13-14. So what was the CII of 13-14? Divide by 220. So 2 lakh into 331 divided by 220 will be how much? 3 lakh 909. Can I say this is the taxable long-term gain? This will not be taxable in the year of compulsory acquisition. This will be taxable in the year in which the amount of initial compensation or any part thereof is received for the first time. This will be taxable in 24. So in the year of compulsory acquisition, there will be no capital gain taxable. Why? Because the compensation or any part thereof is not received in that year. It is received in 24-25. Hence, the capital gain will be taxable in 24-25. Did you understand this? Wait, you are not happy with the compensation. Sorry, the compensation was 28 lakh. Now this 10 lakh later on you are receiving will be again taxable, no? bloody now 28 lakh you have tax. That means this 10 lakh has already suffered tax. Whenever you are going to receive it, at that time you are supposed to ignore. Getting my point? Now, were you happy with the compensation? Why? Because fair market value was, and government gave you, and according to you, you should have got more than the fair market value also, because there were many buyers who were ready to give you 32 lakhs, 35 lakhs, yes or no? And you were very angry that see, the government has taken away my asset and not giving me 30 also, giving me less. So you filed a case against the government in the court. Now case is filed. Now the court will give the judgment. The court will give and in the judgment, if the judgment is in your favor and your initial compensation is enhanced, it was enhanced to 35 lakhs. Enhanced to, you will get 35 lakhs more. 28 lakh was enhanced to, meaning additional compensation you are going to get how much? 7 lakh. Even that 7 lakh will be taxable as your capital gain as per 45(5). 7 lakh will also be amount of additional or enhanced compensation because of the order of the court will also be taxable as your capital gain only. Simple logic. Why? This amount should have been received in the beginning only. This amount should have been received if this amount you would have received in the beginning with initial compensation, this should have been taxed as capital gain. So now also it has to be taxed as, yes or no? So how much amount will be taxed? No deduction for any cost of acquisition, no deduction for any cost of improvement. Why? You have already taken. Hello, you have already taken. But litigation expense to file the case, to fight the case, whatever legal expenses have been incurred, those legal expenses will be allowed as a deduction. For example, the legal expenses were 50,000. How much? So 7 lakh will be taxable. Hello, 7 lakh will be taxable. Cost of acquisition, cost of improvement will be taken as nil. But litigation expenses, 50,000. Reduce that. So that 6,50,000 will be taxable under the head as long term or short term. What was the nature of original capital gains? If that amount would have been received that time, it should have been taxed as. So now also it will be taxable as. So the nature of your original capital gain, that same nature will be for this capital gain also. Yes or no? And it will be taxable in which year? It will be taxable in the year in which the final judgment is delivered and it is received. The final judgment is delivered and it is received. In that year it will be taxable. Will you remember? So here what they are saying, see, if the final court judgment amount of initial compensation is increased, assessee gets additional or extra compensation also known as enhanced compensation shall be taxable as income under the head in the previous year in which the final judgment of the court is delivered and it is received. Deduction for litigation charges shall be available. However, no deduction for cost of acquisition and cost of improvement. Balance amount of additional compensation is taxable under the head. Under section 45(5). Nature of capital gain shall be same as that of original capital gain computed on the basis of initial compensation. Now one interim judgment point is there. Don't focus on this point. That is okay. Okay. Now did you understand this much? Sure. This was your 45(5). But wait. Did the government give you money on time? Tell me no. See, this compulsory acquisition happened on and the compensation you are getting very late. And enhanced compensation also you are going to get after filing the court case. Yes or no? So the initial compensation and the enhanced compensation, usually it takes time. Usually it takes to give this compensation to you. So it always comes with interest. It always comes with interest is not the consideration for transfer of your asset. Only this initial compensation or enhanced compensation is the consideration for transfer of your asset and it will be taxable under the head capital gain. Any interest which comes over and above that cannot be taxable as your capital gain. Has to be your IFOS income. So any interest on initial compensation or enhanced compensation will go to specific charge under the head IFOS. Says that interest will be taxable only under the head IFOS. But there will be a standard deduction of 50% for that interest. 50% of that interest will be allowed as a standard deduction, and the balance amount will be taxable on receipt basis under the head IFOS. No need to focus on method of accounting. No need to focus on entire IFOS income calculated on method of accounting. Incomes to be taken on the basis of method of accounting, mercantile basis, expenses on mercantile basis. Yes or no? But this income will be taxable only on. So now tell me, these 2 years interest you are going to get. Interest for 22-23, interest for 23-24. These 2 years interest you are going to get in 24-25. And you are maintaining books on mercantile basis. Can you say that the interest does not belong to my year? I will not pay tax on this interest. Why? Because I am following mercantile system of accounting. Only this year's income will be taxable. Yes, only this year's income will be taxable under the head IFOS. But the taxability of this income will not happen on the basis of method of accounting. It will happen on the basis of receipt. When it was received? 24-25. It will be taxable in the year 24-25. Both the years interest will be taxable in 24-25. But after taking 50% standard deduction. Will you remember? Under the head IFOS, no, I am not going to discuss about this interest, because entire discussion I have done here. Under the head IFOS, tick, 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 done. Where? PGBP, done. Where? Capital gain. I am going to do that only. Getting my point or not? So this is the end of all the specific charge. Okay. So we'll meet tomorrow, and tomorrow we are going to finish this chapter. Okay. And from tomorrow itself, if the time permits, what are we going to do? We are going to start with IFOS, and immediately I'm going to start with deductions and computation of total income questions. And while solving the questions itself, what we are going to do? We are going to cover the concepts also. I want to solve more questions with you. Okay. So see you all tomorrow. Bye bye.